So by now you've read the headlines. The Federal Reserve has lifted the interest rates. This is their first rate rise of the cycle, the first one since 2018. And you might be wondering, why have they looked to raise rates? What are they aiming to do and how will this help to curtail inflation? What are the potential implications for markets as well as for consumers? And where do things head from here? Particularly as we got some indication about the forecast from their dot plots. Well, if you've been looking for a video that unpacks it all and discusses where things might head, welcome. Hope you enjoy it. Park up with a cup of tea or a mug of coffee. Let us know your thoughts as we go through it as well and drop in a comment below where you think things might head. As we dive into it, I think first and foremost, it makes sense for us to have that step back and think about the context with everything that's played out. We know that inflation has been at record highs. We haven't seen inflation this high over the past 40 years. Of course, we've been in an environment where inflation has been relatively benign and low inflation, and now with the supply chain bottlenecks, the uncertainty of everything that's played out, the lockdowns, the restriction of mobility and border restrictions, all of this has culminated, of course, with the ultra-loose monetary policy facilitating this into record high inflation. We've seen prints from different nations around the world. In the US, 7-8% inflation. In other nations around the world, 3-5%. And so now the focus is, how can we get this inflation that is evidently more persistent than initially thought with that transitory discussion? How can we bring it down to that 2-3% band sustainably that has been requested? So the Federal Reserve has looked to raise their interest rates, initially by 25 basis points. It's the first rate rise since 2018. Really the focus with interest rate rises, which is a blunt tool, it's a monetary policy tool that aims to raise the cost of borrowing, which will look to curtail runaway inflation. Of course, as the cost of borrowing goes up, it means that potentially there's going to be less capital and funds available to spend into different areas of the economy. The rate hike has been well telegraphed. We know the cycle was beginning. It hasn't taken the market by surprise. And incidentally, we've seen the market actually have quite a strong reaction in the initial short-term reaction to it. We did see some indication about the Federal Reserve dot plots. It's indicated 6 rate rises in 2022, 4 more consequently in 2023. We'll talk about what that means later in the video, so stay tuned. And then, of course, there's some uncertainty still surrounding the macroeconomic sphere. Geopolitical tensions, supply chain bottlenecks have not completely subsided yet. How will the growth go and will they be able to stick the soft landing? Well, we'll talk about that all, and actually at the end, we'll discuss what this soft landing means. You might have heard it in headlines or from news reports. We'll talk about what this soft landing means, so make sure you stay till the end, and we'll explain also how the Federal Reserve can look to navigate that. And so the first question that everybody's asking as they observe the market is, where is the neutral rate? So the neutral rate is that interest rate that helps to support full employment and of course maximum output for the economy while maintaining a constant rate of inflation. We know that interest rates have been coming down over the past 30 to 40 years. Of course, they spiked in the 70s and 80s with the great inflation. They've been continuing to move lower and lower and lower. So there's now questions about where is that neutral rate? There's been discussions and potential forecasts about, is it at 2.5%? There is quite a divergent discussion around this. There is no real consensus, but many investors, analysts, and economists are thinking that maybe it's between that 2 to 3% band. And so with that, we got the Federal Reserve's new dot plot out of this meeting here. So the Federal Reserve's dot plot is an indication from Fed officials about where they believe or forecast the future of interest rate paths may head. Now, this is not a forecast from a consensus across the board. This is just indications about individual officials on the Federal Reserve and where they think it may head. And then, of course, you take a consensus with the median between these. We can see here that it's looking like consensus is around 6 interest rate rises for 2022, followed by 4 more in 2023, getting to that neutral rate in between that 2.5 to 3% band, as we had discussed. Of course, what's interesting now is how is the interplay going to be between short-term interest rates, the longer-term interest rates. The 2-10 spread is getting down to 30 basis points. Of course, there's a lot of thoughts about, okay, what happens if the yield curve inverts? Do we have any fears about a potential recession? And of course, this comes to sticking that soft landing and making sure that they don't curtail growth, even though they're able to try to rein in that runaway inflation. And so after the Federal Reserve rate hike, there was a lot of thoughts about, is this going to be an uncertain period? Will we see a tantrum, a bit of a wobble? But actually, we saw the largest S&P 500 rally since 2020. The question now is it a bull trap upwards? Have we started to see a bottoming out? And is this now giving the market the ability to digest the news? Yes, we're into a rate hike cycle. And are we able to look forward? Of course, many indices around the world are still into correction territory. The Nasdaq, we know, entered into a bear market. So there's still some uncertainties about where things head, but it is worth noting that the composition of the recent risk-on rally, it did center around the risk-on asset types. We saw the Nasdaq leading the charge ahead of the S&P, ahead of the Dow Jones, bit of an uplift as well in some of the risk currencies, including the AUD. We saw cryptocurrencies get a bid too. So it's going to be fascinating to see where things head from here. And I'd love to know your thoughts on all of that, so drop in a comment below. And so then, just to get that understanding about how rate hikes actually affect the market, we know that interest rates obviously raise the cost of borrowing, and the raising of the cost of borrowing is then passed on from the banks through to their customers, whether these are corporates, small businesses, individual customers, whether that's through your mortgage, your car loans, or any other types of loans. As the banks pass on these rate hikes, of course, cost of capital increases, which reduces the total amount of capital able to spend. If you have to spend more in terms of your interest repayments, you're going to have less to spend on your holidays or your clothes or any of your other components. And as total spending obviously reduces, that then leads to lower levels of economic growth and ultimately, if all things go well, slower inflation. But this is where the soft landing component comes in, because you don't want to be raising interest rates too quickly. That scares the economy. You then have lower economic growth throughout that, and actually you inhibit economic growth and it may lead to a recession. So that's the difficult dynamic that the central banks around the world are trying to navigate through. We know there's been a high household savings rate. Of course, this will be consumed through over time. It was an atypical period that saw household savings rate raised to record highs throughout 2020 and 2021 as lockdowns were enforced. Obviously, fiscal stimulus was coming through as well as that ultra loose monetary policy. And it is worth noting as well, this is only the first rate hike of the cycle. There will be more. We've talked about the potential forecast on the dot plots. This is a first rate hike, but it's worth noting that it is a cycle. And where the central banks take this to, that's what investors are now watching for. And so that then brings us to the question of sticking the soft landing. You would have heard the phrase before, but you might be wondering, what does this actually mean? I found a couple of these really interesting visuals on Twitter by a tweeter called Tariq Mansour. Really fascinating thread there, actually, if you want to do some further research. But actually, these here really encapsulate the sticking of the soft landing. Obviously, the objective is that over time, the central banks can navigate this period and get inflation to that 2 to 3% band sustainably. That's what they want to see. They want to see it starting to even out and getting to that level where the economy is growing, it's growing well. Living costs and living standards are continuing to improve and grow. However, you're not seeing significant outliers and seeing risky levels of inflation that's going to affect many different market and individual consumer participants. But then if you look at the other side, what's interesting is once inflation gets run away and it gets that genie out of the bottle, it can be very difficult to land that soft landing from the top very hard. And often what you see is central banks have to raise interest rates and raise them quickly and aggressively to be able to curtail that. And often that ends up sending the economies into recession. So this is what central banks are trying to avoid. The question is now, have they left it too late? Have they done it at the right time? It is a fascinating discussion to see play out. Of course, nobody knows. We're going to have to wait for time and wait to see the market dynamics play out. But this is what the question that investors, analysts, and economists are continuing to navigate through. How will they stick this soft landing? And what's the timing been for it all so far? If you've enjoyed the video, don't forget to hit the like button. Make sure you've subscribed, turn your bell notifications on so you won't miss any of our daily episodes. We'll leave links up above to some relevant videos that you might enjoy for your further research. Thank you so much for joining us. For now, stay well and happy investing.